So we just talked about for a firm's cash flow from operating activity, there are two formats, there are two ways to make it. One is called direct method, the other is called indirect method. And now let's look at the difference between these two methods. First, let's look at the direct method. The direct method is basically we take a firm's cash T account. So we have a firm's cash T account, which including all of the cash related transactions that happen within this reporting period for the firm. And we go over each of those transactions item by item, and we categorize all of the cash inflow and outflows into operating, financing, and investing. So here's an example. We have a cash T account for company A, and then those are all of the transactions that affect the firm's cash T account. For example, the beginning balance is 400, and then cash increased by 300 because the firm collect cash on account receivable. And then it increased another 50 because the firm sold its PP&E. It increased another 500 because the firm issued common stock and get cash. It increased 250 because the firm received cash on orders not yet delivered. So it's per payment for the firm received. The firm also paid out cash 180 because it paid vendors for account payable. It paid out 200 to purchase inventory, paid 120 to purchase patent, 280 to purchase PP&E, 130 to repay bank loans. And then the ending balance of cash for the firm is 590. So under the direct method, what we need to do is we look at each of those accounts and then we categorize those. So we look at each of those transactions and then we categorize those transactions into either operating, investing, or financing related transaction. So please take, and then after we categorize each of those transactions into one of the three categories, we then make our cash flow statement. So please take 5 minutes. Try to prepare from A's cash flow statement using the direct method. You can pause your video for now. So let's look at each of those transactions. Collect cash on account receivable. Is it operating, investing, or financing? It is operating because account receivable is a current asset. Sold PP&E, that's investing because PP&E is a long-term asset. Issued common stock, that's financing because issuance of common stock, that's to get finance. And another way to look at it, because common stock is a shareholder's equity account. Receive cash on orders not yet delivered. That's operating as well. Paid vendors for account payable. So that's operating. Purchase inventory, that's operating. Purchase patent. Patent is a long-term asset, so that's investing. Purchase PP&E, that's investing. Prepaid bank loans, that's financing. So after we have clarified, after we have categorized all of those items, now let's just group them into a cash flow statement. So operating activity, cash collected on account receivable, 300. So we have this, and this. And then 250, that's also cash inflow. Cash outflow 180 and cash outflow 200. And then we have cash flow from operations if you add those together. Investing activities, those three. So 50, 120, and 280. So 280 cash outflow to 120 cash outflow and cash inflow 50. Cash flow from investing, you add them up. Financing activities, this and this. So common stock, issue common stock and repay bank loans. If you add up those two, that give you cash flow from financing. And then if you add up these three numbers, that will give you your net cash flow. Your net cash flow, your beginning cash flow is 400, and plus your net cash flow is a positive number, positive 190. So your ending cash flow, cash balance should be 590, which should be this number. So this is a direct method cash flow statement.